Thursday, the 29th of October. Good morning. Oh, say, can you see? Well, here we are again, my fellow Welsh cousins, locked up for our own good, and hoping this virus will leave us alone soon. In fairness, a 2-week fire break doesn't seem too bad, and we're nearly halfway through already. However, as with the media information bombardment in the last lockdown, it is hard to see the wood for the trees right now. I wanted to focus on 2 key areas in this week's lockdown article. One is the condition of the UK, and the other is the US presidential elections that are coming this Tuesday. Markets sold off aggressively yesterday. The headlines attributed this to rising virus cases. I slightly disagree. It is not as simple as that. Right now, the US faces a pivotal election with quite dramatically polarised potential outcomes. Now, the polls suggest that we will see a Biden sweeping win of the presidency and both the houses of the Congress and the Senate. If this happens, there will be ambitious green spending, infrastructure projects, and masses of fiscal stimulus to help the US economy. Before we get too excited by this outcome for portfolios, Biden is very clearly in the tax and regulation camp. This would be bad news for the banks, tech companies, and oil and gas. However, if the polls are not quite right, Biden could fail to win the Senate, which would scupper the stimulus deals, but also slow down the tax and regulation program. Of course, if the polls are completely wrong, we could see an almost identical stalemate situation, but with Trump at the helm and more Chinese sanctions. This is why markets are so volatile. They just crave 2 things. 1, a known outcome, and 2, they're addicted to fiscal stimulus. Add to this the massive collateral damage caused by virus lockdowns, and you can see why sell-offs will be with us over the next week or so at least. All is not doom and gloom in the US, however. Building permits hit a 13-year high last week, with home sales up 9.4% for the month, which is the best level since May 2006. Weekly joblessness numbers also fell to 787,000, which is the lowest level since the crisis started in March, and those continuing to claim benefits fell in a week from 9.4 million to 8.4 million. Like him or not, Trump's America is extremely resilient, and I wouldn't write off the US just yet. In China, they've managed to pull off the full V-shaped recovery. The irony of this isn't lost on many of us, but it is encouraging to see that recovery is constantly a possibility. But what about good old Britain? Well, currently, we probably feel as if we are the most fractured and crackpot country in the world, with all the power struggles between devolved governments and even mayors. However, listen to the US financial news and they're experiencing exactly the same issues across their states. There's no doubt that things have not been good for the UK. Our FTSE 100 index is down this week by around 23% on the year. This is comparable to our European cousin Stock Europe index, which is down by around 14%, and the S&P 500 US index, which is up by around 7% on the year. Even the MSCI World Average stands at around 3% for the year, so the UK is currently looking a bit sick. The reason we didn't see the full V-shaped recovery here that other countries experienced is because we have uncertainty around our future trading deal with the EU. Every week that negotiations continue casts more gloom on UK companies' futures. Honestly, I expect a last-minute deal which concedes much of the EU's stipulations, dressed up as a victory for UK independence. I may be wrong. UK stocks are really unloved right now. This is feeding through into our more cautious portfolios, which naturally will hold far more UK domestic-based stocks to avoid offshore political and currency risks. The winners this year, strangely, have been the more adventurous portfolios and the ethical portfolios that have held more US and offshore exposure and less oil. None of our clients are currently facing large losses on the year, and indeed most are looking at pleasing gains as things stand. However, we're looking very carefully at the UK story. Could there be an argument for the greatest snapback we've seen in a generation once the Brexit business is over? Now, the counter risk to this is that no deal is struck and our supplies are choked whilst inflation rises. However, even in this scenario, there will ultimately be a point where the fifth largest economy in the world comes out fighting. Just as one small point of evidence, tech startup companies are extremely valuable to an economy. At the close of 2019, we had 77 of these startups worth over $1 billion globally. This is over double Germany's tech startups, and they're the second biggest in Europe. Just dare to imagine an Easter in 2021 where a viable vaccine is in place for our more vulnerable citizens, the Brexit debacle is over, and we're able to unleash our talents and abilities globally. Yes, we'll need to dig in and pay down some national debt, but suddenly the ugly duckling might just become a swan. As always, we're here for you 100%. Your portfolios are in good shape and we're on the ball. Nothing is too much trouble. Don't suffer in silence. The media love the gloomy stuff. I can see much better opportunities ahead. Until next week, look after yourselves, stay healthy, and God bless.